Most dividend investors never look past the US border. That's a mistake because some of the best dividend growth opportunities are sitting in Canada waiting for you. Canadian dividend growth investing gives you access to companies with payment histories that make American dividend aristocrats look like beginners. And there's actual structural reasons why Canadian companies are better dividend payers. Here's what you need to understand about Canadian dividend growth investing. The entire market culture in Canada is built around income and dividends in ways the US market isn't. Canadian investors have always prioritized yield and dividend growth over pure price appreciation. That's not just preference, it's baked into how Canadian companies operate. Canadian banks are required by regulation to maintain higher capital reserves than American banks. That stability translates directly into more reliable dividend payments. Canadian utilities operate as regulated monopolies with government-approved rate increases. Their dividend growth is literally built into their business model by law. Canadian energy companies survived multiple oil crashes and kept paying dividends. They learned to structure their operations for cash flow stability, not just production growth. So when you invest in Canadian dividend growth stocks, you're investing in companies that were designed from the ground up to pay shareholders consistently. Different business culture, different results. Drop a comment if you've ever invested in Canadian dividend stocks or if this is completely new territory for you. I want to know how many people are even aware of this opportunity. Let me show you the specific advantages of Canadian dividend growth investing. First advantage is the dividend tax credit system for Canadians. Now, if you're American, you don't get this benefit directly, but understanding it helps you see why Canadian companies prioritize dividends so heavily. Canadian dividends get taxed at lower rates than regular income because of the dividend tax credit. For lower income brackets, the effective tax rate on Canadian dividends can be near zero. That tax structure incentivizes Canadian companies to pay dividends instead of doing buybacks. It incentivizes Canadian investors to demand dividends from the companies they own. The entire ecosystem pushes toward dividend payments and dividend growth. That cultural pressure keeps management teams focused on cash returns to shareholders. Second advantage, the track records of Canadian dividend growers are insane compared to most American companies. Some Canadian banks have been paying dividends for over 150 years. Not just paying them, growing them consistently through world wars, depressions, financial crises. Canadian utilities have decades-long streaks of annual dividend increases, 20, 30, 40 years of consecutive raises without a single cut. Canadian telecoms operate in a protected oligopoly structure. 3 major players dominate the entire market, which means pricing power and stable cash flows. When you buy Canadian dividend growth stocks, you're buying businesses with proven resilience across every possible economic scenario. That's worth something. Third advantage, currency diversification without trying. When you invest in Canadian stocks as an American, you're automatically getting exposure to the Canadian dollar. If the US dollar weakens, your Canadian holdings become more valuable in dollar terms. That's passive currency hedging built right into your dividend portfolio. You're not betting on currency, you're just reducing your concentration risk in US dollars. Plus, your dividends are paid in Canadian dollars and converted when you receive them. If the exchange rate moves in your favor, your dividend income goes up, even if the company didn't raise the payment. If you're getting value from this, hit that subscribe button. I break down international dividend strategies and early retirement tactics that most American investors never even consider. This is how you build real diversification, not fake diversification. Fourth advantage, valuation differences create opportunities. The Canadian market often trades at lower multiples than the US market. Same quality companies, lower prices, higher starting yields. That lower valuation floor means you're getting more dividend income for every dollar invested. Your yield on cost starts higher from day one. And when those Canadian companies grow their dividends, you're compounding from a higher base. That accelerates your income growth compared to equivalent US investments. Fifth advantage, the sectors you need are concentrated in Canada. Want exposure to quality banks that didn't need government bailouts? Canada has 5 major banks that all pay and grow dividends consistently. Want pipeline infrastructure with long-term contracts? Canadian energy infrastructure companies dominate North American midstream operations. Want stable telecom cash flow? Canadian telecoms operate in a protected market with high barriers to entry and rational competition. These sectors exist in the US too, but the concentration and quality in Canada is structurally different. You're getting access to oligopolies and regulated utilities that print money. Quick disclaimer: I'm not a financial advisor. This is for educational purposes only. I'm not selling courses on how to get rich. I'm just someone who figured this out early and feels obligated to share it. Everything here is my own journey. Your situation is different. Your risk tolerance is different. Your timeline is different. Do your own research, but at least understand what's possible. Because most people don't even know this path exists. Now let me address the concerns most people have about Canadian dividend growth investing. First concern is currency risk. Yes, you're exposed to Canadian dollar fluctuations, but is that actually a risk or a feature? If you're 100% invested in US assets earning US dollars living in the US, you have massive concentration risk in one currency. That's not safety, that's fragility. Adding Canadian exposure reduces that concentration. Sometimes the Canadian dollar strengthens, sometimes it weakens. Over decades, the fluctuations matter less than the dividend growth. You're building income in multiple currencies, which is smarter than building it in just one. Second concern is withholding taxes on dividends. Canada withholds 15% on dividends paid to US investors. And even with the withholding, if the Canadian stock yields significantly higher than equivalent US stocks, you're still coming out ahead on after-tax income. Important note on taxes. The foreign tax credit and cross-border dividend taxation can get complicated depending on your specific situation. Always consult with a qualified tax advisor who understands international investments before making decisions. They can help you understand the actual after-tax impact based on your income level and tax bracket. Don't rely on general advice for something this specific. Third concern is lack of familiarity. Most American investors don't know Canadian companies beyond maybe one or two names. That unfamiliarity creates opportunity. When everyone ignores something, valuations stay reasonable. Do your research, understand what you're buying, and you're getting quality dividend growers at prices that don't exist in the overfollowed US market. That's an edge. Let me show you what Canadian dividend growth investing looks like in practice. You're not replacing your entire US portfolio with Canadian stocks. You're adding Canadian exposure as a complement. Maybe 10 to 20% of your dividend portfolio goes to Canadian dividend growers. That's enough to get meaningful diversification benefits and currency exposure without over-concentrating in a smaller market. It's a strategic allocation, not an all-or-nothing bet. You're looking for Canadian companies with long dividend growth histories, 10 years minimum of consecutive increases, ideally 20 or more. You're looking for payout ratios under 80%, so there's room for future growth. You're looking for dominant market positions in oligopoly structures. Banks, utilities, telecoms, pipelines, railroads. These are the sectors where Canada has structural advantages over US alternatives. Here's the psychological benefit of Canadian dividend growth investing. Your income is now coming from two different economies with different cycles. When the US economy weakens, sometimes the Canadian economy is still strong. Your Canadian dividends keep growing even if US dividends stall. That diversification removes anxiety during regional downturns. You're not dependent on one country's economic cycle for all your income. Drop a comment and tell me if you're already invested in any Canadian dividend stocks, or if this is inspiring you to research them. I'm curious how many people take action on international opportunities. Now here's what most people get wrong about international dividend investing. They think it's complicated or only for sophisticated investors. Wrong. Buying Canadian stocks through a US brokerage is exactly as easy as buying US stocks. Same process, same interface. You type in the ticker, you buy the shares, the dividends deposit automatically. The brokerage handles the currency conversion. The only extra step is claiming the foreign tax credit on your annual tax return. That's literally one additional form. Not complicated. The barrier isn't complexity, It's unfamiliarity. Once you buy your first Canadian dividend stock, you realize it's no different than domestic investing. Here's what you could do with this strategy. You could hold Canadian bank stocks, Canadian pipeline stocks, and Canadian utility stocks. They could become a meaningful part of your dividend income strategy because they offer things you can't get as easily in the US market. Longer track records, higher yields, better structural stability. And the dividend growth has been rock solid. These companies raised dividends through every crisis over the past decades. That reliability is worth the minor hassle of dealing with foreign withholding taxes. The income keeps growing regardless of what's happening domestically. Let me give you the Canadian Dividend Growth Investor Framework. Start by researching the major Canadian sectors. Banks. Look at the Big Five. They're all dividend growers with century-plus histories. Utilities. Look at the regulated monopolies serving major provinces. They're required by law to deliver returns to shareholders. Telecoms. Look at the Big Three. They operate in a protected oligopoly with massive barriers to entry. Energy infrastructure. Look at the pipeline operators with long-term contracts. They're toll takers on energy transportation. Once you identify quality companies in these sectors, check their dividend growth history. You want uninterrupted growth for at least 10 years, ideally much longer. Check their payout ratios. Under 70% is ideal. Under 80% is acceptable. Check their business model. Do they have pricing power? Are they protected by regulation or barriers to entry? If all those boxes check, you've found a Canadian dividend growth stock worth owning. It's the same due diligence you'd do for US stocks, just applied to Canadian companies. Here's the mistake to avoid. Don't chase yield in Canadian stocks any more than you would in US stocks. High yield with no growth is still a trap, regardless of what country the company's based in. You want dividend growth, not just high current yield. Some Canadian stocks yield double digits, but haven't raised their dividend in years. That's not dividend growth investing, that's yield trap investing. Focus on companies with 5 to 7% annual dividend growth rates and moderate starting yields. That's where the compounding happens over time. Your yield on cost will grow into double digits naturally if you hold quality dividend growers long enough. Start with growth, the yield follows. Here's my challenge for you this week. Research one Canadian dividend growth stock in a sector you're interested in. Look up its dividend history. Check how it performed during past recessions. See if the business model makes sense to you. You don't have to buy anything yet. Just do the research and familiarize yourself with what's available north of the border. Because the best dividend growth opportunities aren't always in the most obvious places. Sometimes you have to look past your own market to find real value. And make sure you grab the free guide on retirement myths. Join the community where we share international dividend opportunities and track our cross-border income growth. I'll see you there.